Alright, everyone, welcome back to the Sleep Rep Guys channel. Today we're looking at the development of money. This will be lecture 2 on CSEC, the 8 principles of CSEC, I would like to call it. We'll be looking at lecture 2 now, the development of money. So, money is a commonly accepted instrument of or medium of exchange. This could be in the form of coins, banknotes, paper notes. Minority of us already know that money what money is. We've seen examples, we use it in everyday life. It's not something that is uncommon to us. We know about money. It's not something we know. We have it, we use it. It is a medium of exchange. It is a store of value. It serves on all of those categories. So let's look at more than just what money is. Let's look at the history of money and its relevance as relates to that area. So the history of money. So first of all, due to the bartering systems, the bartering systems were sometimes not fair. So the bartering system was sometimes not fair. In the terms of exchange, the bartering system was sometimes unfair. It had a lot of drawbacks and not a lot of positives. It had a bit of positives, but not so much again. It was it was inadequate. It was not the best choice of option. So due to the drawbacks of the bartering system, it led to development of paper money, as we would like to call it. This is an example of paper, but paper money is more substantiative. So traditionally, cowrie shells, cattle salt, and sugar were used as money, but the medium of exchange was not effective enough. For example, um, in terms of transportation, if you were using, like for example, sugar or salt for as a medium of exchange, it would be some substantiatively difficult. So that was out of the question. Then precious metals were used, such as silver and gold, but it became burdensome and heavy. Carrying a large stock of gold or diamond these or silver, it could be heavy, and the transportation and the lucidity or the lucrative nature of these medium of exchange were not effective. We needed something better. The goldsmiths kept the gold while issuing receipts to precious metal owners to represent the value of gold owned. Then the owner would present the receipt when the gold was required. The bearer of the receipt would be paid the gold. Goldsmiths started using smaller denominations such as $10 and $5, and that really gave rise to the idea of actually putting a certain amount of, for example, gold coins would be substantiatively, more expensive than silver or even copper coins, and that is how we developed that ladder of value as we have today with the different forms of lucrative paper money we have in today's society. So new now receipts became a representation of money. Goldsmith became bankers, and the amount of money exceeded the amount of gold or silver in reserve due to loans being given out, which led to greater economical activity. Central banks took over the issuing of monies to stabilize the system. And you might be asking, what is the central bank? There is a major difference between central banks, commercial banks, right? Central and commercial banks, you could probably take a pin, slice it through, and there is a very much deviation when it comes back down to that. So, what are some of the characteristics of money? So, it is generally acceptable by society. Society does accept it as a medium of exchange. It is lucrative. You could carry it wherever you go. We have credit notes now, we have e commerce, electronic transfer, and all of these advanced economical means of exchange in today's society now. So, it is relatively scarce, meaning that we do not have too much of it. So, it still has value now. So, it is easily divisible, homologous in nature, meaning that it's identical to each other. It is fairly durable, and it is portable. All of these characteristics could have not been represented in the case of the bartering system. So, due to the effectiveness, the lucidity, and lucrative nature of money and its scarcity, value, and all of these other factors combined, it made it almost the perfect medium of exchange, and that's why we still use it in today's society. So let's look at some of the functions of money. So some of the functions of money is a medium of exchange, as a unit of price or pricing, as a store of value, store for future use, example savings, means of deferred payment. It makes credit possible. So let's look at some of the terms associated with money. We have the first term we have off the bat is legal tender. So legal tender is a medium of payment recognized by a legal system to be valid for meeting a financial obligation. Paper currency and coins are common forms of legal tender in many countries, meaning that we utilize it to exchange goods, or we utilize it to purchase our essential goods and services. We did talk about premium, or we did talk about our primary needs in the last video: food, clothing, and shelter. And then we have, our secondary needs, which could be inclusive of like our wants. We do not necessarily need it to survive, but sometimes we need it for entertainment purposes such as social media and what's not. So let's look at this other term, which is a fiat. This is an official order or decree by someone in power. An emperor in the medieval period, I would like to call it by the name Bluetooth. He actually invented the concept of paper money. That I think it was around China. I could be incorrect, but he actually introduced the idea in itself to make, and he usually signed his decree on those paper slips, and that was how the introduction of money was actually initiated into the society. So let's look at limited legal tender now. This is money that is accepted as legal tender only to a certain limited limit. Example, coins, because of bulk. Coins could only be accepted because, for example, if you bring a million coins, they will not accept um, all 1 million of that coins due to the bulk of it in general. So coins are token money and legal tender up to a small amount, meaning that you can't have like 8 million in coins. It would be very much unsubstantiated, and they would not accept it. Let's look at some banknotes or paper money. This is fiat money and not valued to gold or silver. Let's look at bank deposits now. This is upon which checks can be drawn. Checks are not legal tender. The deposit is. So checks in itself is not legal tender. So let's look at near money, checks, credit card, debit cards, electronic transfer. These are not tangible money that you could hold in your hand. If you have a credit card, you will have to scan it and connect it to your account through via wireless connection to your bank account essentially, and that's how you could actually buy your goods and services without carrying physical money on hand. So let's look at medium of exchange, a commonly accepted form of payment for goods and services. We have coins, that is the forward medium of exchange. We have literal physical money, that is also another medium of exchange. Gold, medium of exchange, and all these other things are some medium of exchange. Let's look at the term representative money now. Money of no intrinsic value that is used as money to claim value. Legal tender money that has been accepted by law to be a medium of exchange. This could be in the form of gold, diamond. It's basically that in a nutshell. So a check is an order to the bank to make payments to the payee stated on it. That's what a check is. It could be on a paper. It is not literally physically the money at hand. It's so if I were to write a check, I would literally write it and say this and this amount, and then if I were to put it and show it to the bank, they will have a responsibility to pay the payee that amount. Let's look at credit cards dash debit cards. This allows the card holder to make payment by simply presenting the card to the seller. A credit card facility is actually a loan given to a customer, and thus it is to be repaid at an interest. A credit card is it allows you to spend money that you essentially don't have. Um, so when you reach that card limit, you have to pay an interest to the amount of money that you actually spend, and that is how businesses, that's how banks, especially commercial banks, make money. A debit card is issued against the customer's account balance, and it is therefore not a loan. So you could spend. So if you have $1 million in your bank and you want to make it into a debit card, that's your money. You're spending your money, and you essentially don't have to pay back any interest. Let's look at a money order. This can be used to make payments locally or overseas, as they are made at out in the currency in which they are to be paid. The payee will cash the money order at his bank. A money order is basically a tool to transfer money or make payments. Think of it as an alternative check. However, while checks and money orders can serve a similar function, and they also look quite similar, there are some differences to consider. Unlike regular checks, money orders are prepaid. This means they are backed by large agencies or corporations instead of individuals, making them especially valuable because of the safety and reliability that they provide. So there's a big drastic difference when it comes back into the relation between the difference between a check and a money order. So when you're a check, sometimes you do not even need to have that money in your bank to sometimes make a check deposit. But when it comes back to a money order, it's already prepaid, so you don't have to think of paying back anything now. Let's look at a bill of exchange. This is used to pay for goods bought overseas on credit. It is an order in writing from an exporter drawer to an importer drawee, requesting payments of a certain sum of money at a fixed future date. The time period allowed is normally 3 months. So, um, so with the bill of exchange, it really coordinates back to imports. So if I am selling a certain products overseas and I'm selling it to someone, probably in the US or probably in the Philippines. Let's use the Philippines for instance. And I sell that product or I sell a certain good to that person overseas. They have a time period to which they necessarily need to pay that sum. It may be 2 months, it may be 3 months. That's what a bill of exchange generally is. Then we have electronic transfer. This is a system used to transfer funds electronically rather than paper-based payment methods. Funds are transferred over a computer network and makes payments fast, safe, and easy. Examples of these include debit card transactions, remittances through companies such as the Western Union, and money transfer. Those are some examples of electronic transfer. We have telebanking now. This system allows a bank customer to simply use the telephone to get his banking services done rather than visiting the bank. Services include checking account balances and transaction money operated a new account, transfer funds, etc. So let's look at the internet banking system now. This differs because telebanking you have to literally make the phone call. In relation to internet banking now, this differs from telebanking due to the fact that the internet is used to access the services. Customers can go online to view their balances and transaction history and transfer funds, etc. This is very much similar to electronic transfer, but it deviates a lot. So let's look at internet banking. This differs from telebanking in that the internet is used to access the same services. Customers can go online to view their balances and transaction history and transfer funds, etc. So it's very similar. And let's look at now electronic commerce or e-commerce. More popularly called e-commerce is the buying and selling of goods and services using the internet. It allows for a full range of trading activities over the internet, such as advertising, placing orders, delivery, and making payments. So this is all introduction, or this will be lecture two on the development of money, the principle of business. So we'll take a close right there. Subscribe. Hit the next video to lecture three. See you guys on the next video.